In this video, I'm going to teach you how to understand if the stock market is overvalued or undervalued. When we talk about investing or we talk about the stock market broadly, it's really important to understand the general investing landscape. When I choose to invest, or the marginal investor or average investor chooses to invest, they can choose typically either stocks or bonds. Stocks have a compound return for theoretically an infinite period of time. They are the best asset to own in times of high inflation because typically companies can just adjust their pricing to match sort of prevailing price levels. And then, sometimes these companies require additional capital, but they can compound capital at really acceptable rates. You're going to maybe receive a dividend that is a payment from the company from their earnings in the future. The company's earnings may grow in the future. Hopefully they do. And you are going to continue to own equity in that business as it grows. Not all businesses pay dividends. Bonds, by contrast, have a fixed return relative to their purchase price. So I pay $100 for a bond. I'm going to get, say, 10% interest. I am going to then get those payments for that bond over time, and then potentially get a sort of lump sum at the end, returning my principal, right? So the value of the bond is relatively stable, it's understood, but the prices are also impacted by inflation. And typically a bond won't grow past its maturity date, right? So I hold a bond for, 3 years, 5 years, 10 years, 15 years, 30 years. And once it comes to maturity, I receive my principal back, or I have received all of the payments that I'm going to receive for that bond. Stock, by contrast, I can keep really sort of forever and continue to compound that capital for a very, very long period of time. Bonds have historically returned 7 to 8% relative to the S&P over a 30-year period. They require a long holding period because you're typically purchasing them a little bit less than par, but you're also required to hold them to get your sort of full value back, right, as bonds are trading back and forth. But over the long haul, 7 to 8% for sort of corporate bonds has been sort of the norm. It varies, of course, as interest rates change, and we'll talk more about that. Public equities, over a very long period of time, over 30-year periods, have historically returned about 11 to 12% in the S&P over that period, right? The holding period, there is some variability in that holding period, but generally speaking, if I were to hold a broad-based index, I'm going to get a much higher return than I'm going to get in bonds. But it also requires an extremely long holding period because I'm purchasing at a high price. What's interesting is that the historical return on equity for the U.S. markets has actually been much closer to sort of 14 to 16% over a really extended period of time. So you're sort of averaging out, looking closer to 15%. And here's some data from NYU Stern, which kind of shows that. So we're not talking about inflation in these numbers, but we will talk about inflation here in a minute and how that affects if the market's overvalued and undervalued. So most investors have a long time horizon. That have a long time horizon would probably naturally lean towards stocks. If I can get a much higher return and I can stay in and deal with the volatility of the market, I'm going to go with a stock because it can compound for longer than sort of 30 years. Bonds, by contrast, are something that's much more stable. I can typically count on the income. I know that if my sort of investment is going to go sour, I'm going to get my money back before a stockholder gets their money. Because when companies go bankrupt, it's typically the bondholders that get their money back first, or get the liquidation value of the business ahead of the equity holders or stockholders. And that's not always the case, but generally it's understood that bonds are much more secure. And this is part of the reason why we say something called an equity risk premium. That is, I receive a premium for having ownership in a stock and not being secured in the same way that a bond is. So that's where that sort of extra 2 to 3% in return sort of comes from. Now, really importantly is that changes in interest rates naturally affect the available investment alternatives. If stocks are companies that can borrow very, very cheaply, and interest rates are low, because interest rates are low, they're going to have sort of natural benefits. Conversely, if interest rates are very low, then bonds are not going to return as much money as if interest rates are high, right? I'd rather purchase a bond returning 15% per year than purchase a bond that is returning 2% a year. Um, and if stocks are going to sort of be able to outpace inflation, et cetera, and they can also borrow cheaply, it will sort of naturally make sense to purchase a stock rather than a bond when a bond has a really, really low yield. So as bond yields change with interest rates, my alternatives change. That is, what makes sense for me to invest into changes. And so we'll talk more about that here in a minute. Interest rates have actually not been as low as they currently are in really about 80 years. And so if I go back to that consideration about, well, what investment alternatives do I have available to me, stocks or bonds? And bonds are returning, 1.7%, or 10-year treasuries are returning maybe 2 to 3%. I'm probably going to naturally look for an alternative that's going to give me more value for my money over a long period of time. The only other alternative is, of course, investing in stocks. Well, S&P earnings continue to rise year over year, even going back to sort of the 1990s, following Black Monday, go to the sort of 2008 crisis. Companies are pretty resilient. They bounce back. Yes, there is a crazy amount of volatility, and that's what you're seeing here in this chart. But year over year, large companies have been able to increase their earnings, and this is what this shows in the S&P. GDP growth is the measure of, how productive are Americans, right? How productive is the economy, the gross domestic product of individuals in the economy, companies broadly. And actually that's been slowly on a decline. We're kind of averaging, or have been averaging, 3% in sort of recent years, recent decades. And we're probably leveling out as the economy matures, right? There's not as many really massive efficiency gains that we can get. They're going to be much more incremental going forward, unless there are some other changes in technology that make everything much more wildly productive. So how do I know if the market is overvalued? Well, probably one of the best measures is actually to look at GDP, which is the total output of markets relative to market values, right? GDP to market value. And what you're seeing here is that in some cases, the GDP growth well outpaces the growth in the total value of the market. Why is that? Why in some years is the market growing faster than the rate of the value of those businesses, right? So if I think of the purchase price of the business in the marketplace, if that price of that stock is going up faster than the total growth of GDP, then naturally the price of that stock could become more expensive relative to its growth rate, and becomes too expensive, right? So the markets can be overvalued, and that's what you're seeing here in this chart. Is there's periods of time where it looks like markets have been overvalued relative to GDP growth. It's not a certain outcome. What we're experiencing now in the sort of after 2013 and going into 2020 is a period of time where there are fewer and fewer alternatives available. So we go back to our previous chart here and we see what interest rates are doing. You see that interest rates are so low that people are actually out of alternatives. If they need to push for yield, then they need to invest in stocks, because bonds are not yielding any significant amount of money. So I have the alternative of getting a really low return on my investment when I invest in treasury bonds, or I can invest in stocks and get a better yield. And so what you're seeing here is that since 2013, people have been piling into stocks, and this has probably raised the historical ratio of sort of market cap to GDP to pretty historical levels. We've experienced very high levels of valuation in the past, but the future valuations are not certain. It's not a certain outcome. Valuations can't really be known in terms of future value because part of how it's calculated is a change in people's moods. And we've written a blog post on this on thesiscapital.com. It's how to invest in low interest rates and low interest rate environments and in markets versus companies. But if we were to have sort of a perfect investing formula, we would say the future value of the market is its dividend yield plus its earnings growth plus its change in valuations. Well, the change in valuations is, again, a function of sentiment, right? So if people think that they're going to get a better yield by investing in stocks and not investing in bonds, and everyone crowds into stocks or piles into stocks, then that is going to push up future valuations. Now, if interest rates rise, then actually what happens is more alternatives become available for people to invest in. They can choose to invest in bonds, receive a lower yield, but the difference between stocks and bonds really becomes that sort of perceived safety or perceived return. And in many cases, people who are maybe closer to retirement or they want a little more safety are going to choose bonds rather than stocks so that they can have that consistent return over an extended period of time. But this change in valuations really just isn't something that we can know definitively because we can't predict the future. Now, there's something else to be said is inflation. So inflation is the change in the purchasing power of money over time. Inflation has sort of been tamed since the wild days of the 1920s, but it does periodically rear its ugly head, in periods of crisis and when basically the Federal Reserve needs to print a lot of money and other macroeconomic effects come into play. So when I own a bond, almost definitively my investment in that bond is going to be inflated away. The value of that money is going to be inflated away. Whereas when I invest in a stock, if in periods of high inflation, again, those companies can adjust their prices to basically manage inflation. So I may be a little safer as it relates to an extremely long period of time in stocks relative to a period of time in bonds during periods of high inflation. So to conclude, interest rates really affect the available alternatives for investing in the market. If interest rates are really low and they stay low for a very long time, that's probably going to push up asset values and make the stock market actually much more expensive than it historically has been. We can't know the future of asset values because we can't price in that future sentiment with absolute certainty. And so that makes timing the market very, very hard. And then, of course, inflation is always a lurking variable. So this concludes our discussion as to how to determine that if the stock market is overvalued or not. Again, probably one of the best measures is looking at GDP to total market value, and then also understanding where interest rates are at any given time. If interest rates are super low and GDP to market value is high, then it's probably a pretty good measure that the stock market is overvalued. Conversely, if interest rates are very high and the total market cap to GDP growth is really low, then perhaps the market is fairly valued or undervalued. Hope this is helpful. Thanks, and see you at thesiscapital.com.